Welcome to this edition of the 2-minute monthly summary. As you can see by this chart, the S&P 500 was down as of September 23rd, about 22.5%. Now that's not the all-time low for the year. And by the time that this actually gets to you, it's possible that it could have touched that all-time low or could have come back a little bit more. I think we're going to test that a couple of times throughout the rest of this year until some things are figured out with regards to inflation, what's going on with earnings growth, and where we're at in the economy overall. As you can see by this chart, the market is down 22% as of this recording, which the last data point is September 23rd. The total pullback this year has been 23%, and as of last Friday, it was down 22%, meaning last Friday was the 23rd as this is being recorded. The average year, you'll see, has drawdown throughout the course of the year, and each year has had negative returns, even though some years have ended up. I know I showed you this chart last time, but I think it's really important to reiterate the points here. When we look at the market correction and recoveries of the S&P 500 since World War II, the average market correction from peak to trough declines about 10 to 20%. Now we're already beyond that, as I mentioned, and the bold line is the average across all corrections. The interesting part to me is that while recoveries don't happen immediately after a downturn, they can occur very swiftly and on average only take about 4 months. That's why it's so important to stay invested and to continue to invest so that we don't miss out on those market rebounds. One of the things that we are having a lot of folks ask questions about is this inverted yield curve and interest rates and how that overall affects the economy. And honestly, it's not so much that it affects the economy, well, other than the fact that it makes things more expensive to purchase, not just on a consumer level, but a manufacturing level. But what is interesting about interest rates right now is the 10-year and the 2-year yields have completely inverted. And you can see that on this chart. It's not just a small inversion, it's a pretty significant inversion. When you look at the 2-year being at 4.2% and the 10-year being at 3.69, where is the reward in going long in this type of investment? So this is what you hear about being in an inverted yield curve has historically given a signal that we are about to or are headed into a recession. So that's why we're actually watching it. You can see by looking at this chart that non-manufacturing actually ticked up just a little bit in the month of August, but manufacturing fell pretty significantly from July to August. And we're going to continue to watch this very closely. This could be an indicator that indeed the economy is slowing down. Finally, we share with you the overall asset class performance chart. As you'll notice, the balanced portfolio in this situation, although down significantly, over 17%, is in the top 3 categories of asset class performance. This is why we impress upon our clients to stay in the market and to stay invested and to stay in a balanced portfolio, because as you can see, international markets, even the S&P 500, are underperforming a balanced portfolio. One thing that is unusual when you look at this chart, you'll see that although commodities are positive this year, it is the only category that's actually positive this year, and it has fallen from its peak. So again, we just impress upon all our clients to stay in the market, to continue to have a balanced portfolio. And if you have any questions, please reach out to us.